Good afternoon, good morning, good evening, ladies and gentlemen, depending on where you're watching from. Thank you for creating time to listen in to this video. In my previous videos, I've been speaking about various assets, various investment classes. I've spoken about cash and cash equivalents. These are things like the money market funds. These are things like banks. These are things like money that is in your M-Pesa. That's cash and cash equivalents. There's also the fixed income, which are mainly the bonds. They are called fixed income because they have a fixed rate of return for a specific period of time. Then we also have the equities, which is your stocks or the stock market, and other investment vehicles like the cryptocurrencies, the things like commodities, and things like circles, things like real estate. But I want us to dwell further on the aspect of real estate in this video. As you are aware, investing in real estate can bring you significant returns, but it comes with its own challenges, ranging from high cost to it requires a lot of your time to manage the real estate. There's fluctuations in prices and all these nitty-gritties that real estate comes with, all the way to even dealing with tenants, especially if you're working with apartments. So real estate, in as much as it's a good, very lucrative investment vehicle, it's not for everyone. And this is why today I'd like us to discuss an alternative for people who do not maybe have the time, do not have the money to invest in big projects that can give you adequate return. They do not have the know-how, and most importantly, they do not have enough knowledge, or just knowledge, or you are not well versed in that aspect. So this alternative is called Reits, R-E-I-T, Reit. Forgive me if it sounds like rate, but it's R-E-I-T. This is a very interesting investment model that allows you to participate in the real estate while not directly owning that property and while not being heavily involved in the weight lifting that is involved in that area of investment. So rates, just like the unit trust. If you've watched my videos on unit trust, we said that unit trust is some of the funds that you invest in, the collective investment schemes or the mutual funds, where different people bring in their money and it's invested on their behalf. So the rate is almost the same as the unit trust, but now it's in the real estate sector. Remember, in the unit trust, you're investing in other assets like money, you're investing in the shares and all that. But in the rate now, you're investing in real estate projects. So what happens is that when you buy a rate, when you get into the rate, you become like a shareholder. Just like in the unit trust, you are a shareholder in that project. So for instance, you've bought into a certain project, you've bought 20 units. It means that you are a shareholder in that kind of a project. That then means that you benefit through capital gain as well as the dividends. So for instance, you've invested in the project and it's made returns. So when they're sharing those returns, you will benefit as well through dividends that are declared periodically, and the capital gain. Capital gain is a scenario whereby, for instance, you've bought in X project and you've bought maybe the price of a unit is 20 shillings. Then you put in 1 million. So it means that your value is 20 million, okay? So assume 3 years down the line, the price of a unit goes up to 30 shillings. It therefore then means your value at that time will be 30 million. That is capital gain. That's how then you get to benefit or to make money from the rate. And remember that rates are regulated by the Capital Market Authority, just like the unit trust. They are regulated. And that's important because it being a new concept, some wealthy individuals could come up and form a group. So they form a group and they put up some malls or some high-end offices or some apartments, and then they float it in the market for people to buy. So you have to be very wary of that, because that is not, if it's not regulated, you could find yourself getting into projects that lack credibility. So it's always important to find out if that particular rate you want to invest in is regulated by the Capital Market Authority. So these rates then help you to take part in these income generating projects like major big office spaces, the malls and the apartments, or any other big major real estate projects that are happening, without having to break the bank, without having to need so much money as would have been the case if you're doing it directly as a single investor. So it's just to understand it, think of shares. When you are a shareholder in a certain company, that means you own a piece of that company. You have a share in KCB, or you have a share in Equity Bank. It means that you own a piece of that bank. The same case with rates. If you have some units in a certain project, it means you own a piece of that project without having to buy into the entire business of the real estate. So what are the benefits of investing in rates? The first benefit is the aspect of diversification. In one of my previous videos, I spoke about principles of investment or principles of investing. One of the key principles is diversification. Never put all your eggs in one basket. So it's always good to diversify. So the rates give you an option to diversify from the other investments that you're doing. The other thing is that it gives you liquidity. We've said that rates are listed in the Nairobi Stock Exchange, and so you can buy and sell just like you do with your shares online. You can trade as and when you want, and that gives you a sense of liquidity. When I was speaking about the issue of land, one of the biggest disadvantage was the illiquid nature. So it's important to diversify. In as much as you have land, have other instruments that are liquid. The other benefit is the tax benefit. By now, I believe all of you have a master's in tax in Kenya, tax issues. So rates are exempted from stamp duty tax, they're exempted from value addition tax, they're exempted from capital gain tax, as well as income tax. The only tax you pay on rates is the tax on withholding, the withholding tax on the dividends, which is just 5%. So that helps you with that aspect of tax benefit. The other advantage of rates is that they are professionally managed. Maybe you're not well versed in the real estate sector, you are versed in other areas. So that becomes an advantage because the people managing are professionals and they are able to make the right decisions with your money. The other thing is that it helps break the entry barrier into real estate. Believe you me, even thinking of real estate, even the word, thinking of investing in a major project is already intimidating enough because you need quite some good amount of money. And if you do not have a very good credit rating to be able to get to leverage on the loans from the bank, then it becomes a tough situation to get into this. So the rate helps to break that barrier because even with as little as 2,500, you're able to access some of these things. You might not realize so much returns with a little amount of money, but it will still be a good idea to try out some of these things. So, ladies and gentlemen, you make money in the rates because according to the law, actually, they are required to give out 80% of their income through dividends. So over the years, you're able to capitalize on the aspect of dividends and enjoy that. But always remember, just like in the stocks, real estate is also a long-term kind of investment. Don't put in your money today and then you get dissatisfied, and tomorrow, next year, you are pulling out your money. Think long-term and diversify in that kind of a space. Thank you, ladies and gentlemen. I thought I should share that additional avenue that we can make some money from. Bye-bye.